Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy any investment based solely on a tip or recommendation. Please do your own research.
Hello and welcome to the Midweek Takeaway. Today we're thrilled to be joined by Sapan Ghai, CCO of Sovereign Metals. Sovereign has just delivered an exciting optimised pre-feasibility study for their flagship Kasiya Rutile-Graphite Project in Malawi, reaffirming its position as the world's largest natural rutile deposit and second largest flake graphite resource. This milestone highlights Kasiya's potential to become a long-life, low-cost supplier of critical minerals, with impressive numbers including a $2.3 billion pre-tax NPV and $16.4 billion in total revenue over its 25-year mine life. With strategic input from Rio Tinto and a focus on delivering sustainable mining solutions, Sovereign is setting the stage for significant global impact. Sapan, thanks for joining us. So just talk us through the rationale behind conducting the optimised pre-feasibility study, and how does it refine the previous PFS findings and ultimately enhance the project's feasibility and profitability?
Good question, Phil. So look, this is what we've done. We, as Sovereign Metals, completed a pre-feasibility study in 2023. That was as Sovereign Metals, a standalone junior, going ahead and trying to figure out how best to mine, operate, produce rutile and graphite out of the Kasiya project in Malawi, and get the best economics out of it for all shareholders, all stakeholders. Since then, we've obviously had Rio Tinto come on board as a strategic investor. They now own just under 20% of the company, and we've grown the team from a few engineers, a few geologists, a bunch of bankers and accountants trying to figure this all out into actual real mine builders. You know, we've got a team that's built 13 mines, mostly in Africa, over the last 20 years. They know what they're doing. Rio Tinto know what they're doing. So we took all that expertise, we targeted that expertise at our 2023 pre-feasibility study and said, guys, turn this into something that is massively de-risked, is as realistic and close to a definitive feasibility study as you can get without it being one, and tell us what that looks like, and that's what we've announced today with the optimized PFS results.
You see, Sapan, I mean, I when we were talking sort of just over a year ago, I started chatting to you about Sovereign Metals, and we were talking about all these things that we needed to de-risk before Rio Tinto might be convinced to make an offer for the asset. And we were like graphite testing and SPG, and optimize the pre-feasibility study, which we've now got, and like backfill testing and the pilot plant and everything else. And it feels like we've checked off everything on the list. So when is the check coming in the post? And do you get like a big cardboard check that you get to like hold in front of the mine and like blow champagne like lottery winners? Or is it less fun than that? Is it like a digital
Isn't the
transfer?
postcode lottery, Charles?
Yes, it's not it's the Malawi lottery, and the winner is...
No, look, guys, as it stands today, Rio Tinto is a pure strategic investor. They own just under 20% of us. That's all they can own without triggering a mandatory bid. Yes, they do have an option to become operator of the mine, which kicks in straight after we announce a definitive feasibility study, which we'll do later on this year. But we're just pushing ahead and advancing this thing, right? So we know how much it can produce, what kind of economics are around it, what kind of capital outlay we need to do so to build this thing, and we're fully engaged in discussions with banks, off-takers, future customers, governments around the world. We're doing the whole shebang, to use a technical term, in terms of moving Kasiya forwards with the type of organization and management that it requires to get a tier 1 project up and running. And now, in between now and then, if there is any corporate action from our strategic investor, obviously we'll deal with that situation as and when. But for now, we're plugging away to look at building a mine that would be the largest and lowest cost producer of rutile, potentially the only primary producer of rutile in the world. It would be the largest and lowest cost producer of graphite in the world. We're churning off over $400 million of gross profits a year for at least 25 years, if not 75 years. And we need we need about $660 million to do that. So we're in the process of all those discussions that I've just touched on.
How would you're talking? Yeah, 665 million Capit Expenditures first production. I guess the question is, I mean, I've seen companies try and struggle to get hold of that kind of money to build their mines. Obviously, you've de-risked this massively, but how would that look? You know, in the event that Rio Tinto doesn't buy you out and they're happy to just be your strategic investor, which is very possible as a future. You know, I don't think that's going to happen, but it is a possibility. How would that capex look? You know, a mixture of debt, equity. I don't know.
Debt, offtake agreements, prepayments, anything to make sure that equity holders, including myself, are face minimum dilution in that. My past as a banker, I've done this a couple of times. Our chairman's done this a few times, and we've financed quite a few mines, specifically in Africa, over the past kind of 20 years, to the tune of I'd say maybe around $6-7 billion. So what's another 665, right?
Oh, it's nothing between friends, pennies, really, isn't it? Yeah, I guess. Okay, so you know this optimized study that you've done, which you said has been done, you know, in effect with Rio Tinto, well, the Sovereign Rio Tinto Technical Committee oversight. It's very similar. I mean, I read through the document yesterday, you know, 100 pages or so. But what would you say are the key differences? What's changed here? If at all, if anything major, I mean, not much seems to have changed beyond potentially the dry mining. But
yeah, so let's take a step back. The whole purpose of this optimization, you know, people use the term optimization and think that means my value is going to increase, but really, the way we saw it was an absolute de-risk approach. So the mining methods changed, right? We talked about hydro mining in the PFS, and that's a mining technique used across Africa on these types of deposits. But it does have its own issues, right? So hydro mining, there are safety concerns with it. There's obviously water usage, which is within a continent like Africa has its own concerns. And one of the key things is when you hydro mine a pit, everything kind of congeals into one slurry, so you can't focus on higher grade rutile or higher grade graphite areas the way you can.
It's a cocktail.
Right. Yeah. So you know, having those discussions with Rio, we decided, look, let's go for a low risk approach, which gives us greater operational flexibility, and go down the dry mining route where we use drag lines. So you know, this is not excavators down at the bottom of the pit that can again cause its own safety concerns. These are big drag lines with the booms. You know, they're sitting on the bench of the pit, so at the top of the pit, and just picking up the material down at the bottom of it, sticking that into a bunch of trucks. Those trucks then truck it over to a couple of plants, one in the south and one in the north.
Is that something that you figured out during the build and the use of the pilot plant?
Yeah, so the whole pilot mining phase, as you remember, we did some dry mining, we did some hydro mining. They can both work, but one of the key issues we found, not issues, one of the key advantages we found of dry mining is that we can specifically start to target certain areas of certain pits in a much more economically efficient approach, shall we say.
Okay, so there's elements in while you're mining where you've got much higher grades of, say, rutile or graphite, and by doing dry mining you can get better quality out of the ground effectively, is what you're saying. Is that a fair summary?
Yeah, and one of the things we've learned about both rutile and graphite is, you know, the type of material that you're mining has a bearing on what kind of product you're selling, which obviously then has a bearing on who's paying what for it, you know, your customers and what their demands are. And if we have greater control over that, we have a greater chance of meeting our customers' product requirements.
In terms of the operating cost, $423 per ton. I mean, you're talking about this being one of the lowest, if not the lowest, operating costs for both rutile and graphite. I mean, what are you comparing that to real world, like other companies in the region or even worldwide?
Look, let's talk about the rutile. We are $400 a ton. It's really unheard of mining rutile at that kind of price. Today, you know, rutile sells in the market for close to $1,700 a ton. So you can start to gauge, even at spot, what those margins look like. On the graphite, I would say we are the lowest cost producer globally in graphite, full stop. At $241 extra that we would have to pay in operating costs to get a graphite basket that per ton, the experts are telling us could sell for $1,800-$1,900 a ton. But in our models, we've been quite conservative with $1,290. We think we would, to use a term used by one of our investors, we could potentially be a category killer in the graphite space here.
Lovely. Category killer. Well, I guess, with Trump in charge now and the executive orders, I mean, he signed about 1 million of them on day one. And he's kind of like, it's mad rush to get things out. But I mean, a few of them have caught my eye, regarding critical minerals. And I guess the question is, in terms of potential grant funding, even, or even like importance to the US government, graphite and rutile are critical minerals. The China-US tensions and the critical minerals export bans that are coming in. I mean, you are very well positioned, aren't you, where you are in the world?
Yes, very well positioned indeed. The rutile.
Don't say any more. Don't say any more, Sapan. Just say yes. End the story.
Oh, hang on. Do we have to do some digging here?
Yeah, look. So why is rutile important? Rutile is like the purest, cleanest form of titanium you can find naturally, right? It's what the titanium metal producers love. They love rutile because everything else that you can find on planet Earth has to be upgraded, has to be smelted, roasted, and then when they get it, it's like an 80% titanium product. Whereas I'm telling them we've got 95, 96, 97, 98% titanium product in the ground, and all we're doing is essentially sieving it, cleaning it, washing it, and handing it over. And so these guys are taking this, producing, titanium dioxide or titanium metal. And titanium metal is, as you mentioned, critical, strategic, whatever adjective you want to use for the day, for the US, for the EU. NATO, towards the end of last year, came out with their own strategic raw materials list, had both titanium and graphite on there, and said these are critical for the Allied Defence Force going forwards. And to have the world's largest rutile deposit, which can withstand price fluctuations, geopolitical fluctuations, cost inflation, and have real operators behind it, that gives a secure supply of that rutile into the likes of the US, the EU, and the Japanese, who tend to make most of the titanium metal that then ends up in your F-35 fighter jets or whatever else you may be using it for.
Well, I love the rebranding of the website with the fighter jet. I mean, immediately after, almost every other company in the sector looked at that idea, went, fantastic, we'll be taking that. Good work for you. But I think in terms of like more technically, I'm not sure how au fait you are with the flow sheet. But if you're dry mining, the plant, the material is not going to be wet. So presumably you're going to need to have scrubbers and maybe a couple of screens. But beyond
Correct.
that, I mean, has the flow sheet changed at all?
No, beyond that, it's exactly the same as it was before. The process has always been pretty conventional. It's been pretty off the shelf. There's no funky
That's my next question.
Or any of that business going on. It's literally using the density, the gravity of these products versus everything else that they're mixed in with to separate them out.
So I mean, when I think of a flow sheet, you'll laugh, but I think of like Wallace and Gromit, and Wallace, building his rocket and all of his designs. But I mean, is all the equipment that you're planning to use pretty much off the shelf, by and large?
Yep, and we have pilot level equipment of that already, right? So last year we brought in a spiral and set that up at our facility in Lilongwe in Malawi, and that currently produces some bulk samples of graphite concentrate. That spiral is exactly the size and scale of what we'd use for the gravity separation stage of the process. Just we'd use a lot more rather than just the one spiral at full pelt. We've got a bench scale electrostatic separator, got a bench scale magnetic separator. These are simple pieces of kit, and when we're producing, or at least we're producing samples of rutile and graphite as we speak, all on a bench scale, and it's just a matter of getting the bigger brother of each of these pieces of equipment.
Yeah. Well, it's easier said than done, isn't it? I mean, I've been to a few of the larger mines, and the size of the operations. I mean, your pilot plant. I mean, we're looking at back of a fag packet maths, but it was about 5% of what you think the real thing is going to be, and so you get the sense of scale. I guess where you are in Malawi, getting that equipment to site, actually building the mine, that's a massive undertaking, isn't it? I mean, how many years are you thinking in terms of from starting to production?
So look, in terms of timing, from the point that we decide to go full pelt, so an FID, so to speak, to production, you're talking about 2.5 years of build time. But it's not an issue getting this stuff right. So yes, Malawi's kind of a little bit unknown. It's landlocked. Not a lot of export comes out of there right now. But we've shown that we can get spiral plants there. We've got equipment from South Africa and other parts of Africa to there. We've had excavators and trucks and engineering firms and civil engineers do the pilot mining for us. So it's not that difficult. And just to put it into context, there's a Caterpillar showroom about 20 clicks away from our offices. So it's all there.
Yeah,
it's not going to be difficult.
the railway right nearby, isn't there?
Well, the railway's on the project.
It's on the land, yeah. Well, I mean, depending on your perspective, it's a big old property, isn't it? I mean, you wouldn't want to walk it back and forth. But I don't know. I guess for me, it's sort of this water management. I mean, Zambia and right next to Malawi, and the droughts and the lack of rainfall they've having. I mean, how much of that decision was based on trying to future-proof the project against potential lack of ability, there not being enough water in the future?
It was more a view of ESG is bandied around by a lot of people, and it has been in the past. I'd say someone like a Rio Tinto, they live and breathe it, right? So for them, water management, water usage, decreasing the amount that of water that any of their projects demand is a big thing for them. And for us to have gone back and said, okay, well, we're not hydro mining this thing, so we don't need all that water being pumped to all these water cannons around the project. I mean, that's decreased the size of our water dam by nearest damn it 40%, and our team is actually looking at decreasing that a further 50% right now. So there's big gains to be had in that, and not just from the environmental footprint and the social footprint of it, but actually just from a technical standpoint and a technical de-risking standpoint. We're miners, right? We're miners, we're operators. To look after a huge water dam, essentially a reservoir, takes certain skill sets that, yes, a Rio Tinto has, but they'd rather look after a small one rather than one of the biggest ones on the planet.
Yeah, that makes a lot of sense. I mean, in terms of the ESG, ESG potentially it's an interesting one because more broadly it's becoming something that's investors, some investors are very excited about, others aren't. I mean, in Malawi, the country itself, I mean, major national newspapers are talking about sovereign metals quite a lot because actually the value you will bring to the country is nationally important. And I guess the question is, what are you bringing to Malawi that's going to improve, the lives of the people there, but also the country itself? Bear in mind, it's a very poor nation.
Yeah, so we're obviously there's the economic side of it, there's the fiscal side of it in terms of taxes, royalties, all the rest of it.
Yeah,
but there's a lot of jobs. There's a lot of upscaling of a workforce. There's a lot of indirect jobs. We believe for every one job at Kasiya directly employed by Sovereign Metals, there'll be 6 or 7 indirect jobs related to that. All the infrastructure required around a big mining project.
Yeah, open a hotel next door. That's exactly. Name of the game, isn't it? Yeah.
So there's that. And then we've made no qualms about our rehabilitation of the land, our conservation farming program. All these skills that we're inputting into the locals to get full stakeholders to essentially understand that we're not just taking these minerals out of the ground and then leaving them with a big hole in the ground. We're actually, and we're working on this, and hopefully you'll hear a bit more about this, but we're actually giving the land back in a better position for agricultural use than before we even mined it. and that would be a massive plus for us.
But so with the net present value 2.3 billion, Rio's effectively signed off saying yes, this thing is worth 2.3 billion objectively. I mean, subjectively, though, obviously nothing ever sells for a net present value. Not well, actually, I wouldn't say nothing, but it rarely does. So we'll go back to that valuation question. What kind of number would Rio Tinto have to come to you with tomorrow morning for you? It's not your opinion. It's not, you're not allowed to sign on the dotted line. But if you did have that power, what number would you say yes to? Because like presumably $5 would be no, but 3 billion would be a resounding yes.
Bob, you know I'm not going to answer that question.
No, I know you're not. I will ask it anyway.
No. Look, all I'm going to say is yes, that is a strategic future outcome. But in terms of what what happens in the mining M&A world, having done umpteen deals in the last 2 decades, all the way from working on the BHPs of the world down to the real juniors, and mainly focusing on Africa, mainly focusing on ASX, TSX listed companies. What I'll tell you is when projects get bought out, they get bought out at a specific premium to the prevailing share price. Right? It's not, regardless of what the project may be worth to the buyer or to the seller, the market is where that, the market's going to answer that question for you. And currently the market's telling the world that, this project's worth $300 million, whereas we just released a piece of paper saying it could be worth $2.3 billion.
So we need to get that share price up. It's a fun game almost, isn't it? Because in order to, what you're effectively saying is that in order to achieve that price that you're hoping to get, you need people to buy the shares, but people aren't going to buy the shares unless you can promise you're going to get that price. But for me personally, you're saying this, and yet this is a strategic project, not just for Rio Tinto, just globally because of the rutile. They're not making more rutile deposits. No one's finding any. I mean, when was the last time before Kasiya a rutile deposit was discovered?
Kasiya rutile, like a primary rutile deposit.
Yeah, primary rutile.
Area 1 mine, which has about 2 years left and has been mined since the 1960s.
So, we're talking just after World War II, pretty much, is when the last one was found. I kind of feel like it's obviously Rio Tinto is a massive major mining organization, and obviously the ideal situation is they come to you with a fair number, but you have the capacity to build the mine and get it done yourself. But I guess the question is, every day that they leave it now to not come with a reasonable offer, other parties can come in, right? There's nothing in the deal that you have with Rio Tinto that prevents anybody else from making an offer, is there?
Anyone else can make an offer. Rio Tinto have a right to match that offer.
Good. Well, I'll make an offer tomorrow. I'm not sure they'll pay attention.
And the other thing to note from our investment agreement with them is that we cannot sign off takeaway without their approval, but it doesn't preclude us from having discussions with potential future off-takers.
Good.
That just simply gives everyone flexibility to carry on.
That's fair enough. I mean, well, they've put a lot of money into the company as well. I think this is the other side of the coin that people maybe don't think or see in terms of like long-term strategy. While you have a lot of optionality, they came to you, they invested in you. They've helped Sovereign Metals a lot, especially not just with money, but also with the technical committee. So they're and owning 20, just under 20% of the company. They're almost. I wouldn't use the word owed because nobody's owed anything, but they're also. It's a very respectful partnership, I would say. With both sides are very happy with each other at the moment.
Yeah, look, a good example of Rio's input into all of this is, for example, on the tailings dam, the tailings storage facility. We mapped one out for the PFS, but we don't, as Sovereign, as it was, 2023 Sovereign, did not have the expertise on tailings facilities the way a Rio Tinto, who has umpteen of them, all singing, all dancing, all working to a global standard. We just didn't have that, and now we do. And so we've managed to reduce the tailings storage facility massively by just introducing this concept of mud farming. Well,
by 44% is what I'm reading here. Yeah.
Which we as a group, we were looking at the usual ways that you can you could decrease your tailings footprint. Things like using filter presses, drying out the tailings before you stack them, all that kind of good stuff. And Rio comes along and says, well, we've been using this technique over in Queensland in Australia at our bauxite mines there. We think it could very easily be achievable here. So we ran a quick feasibility on whether it can, and it looks like it can. So we incorporated that into our study. And for those who don't know what mud farming is, go on YouTube, type in mud farming. Lots of lovely videos on there.
Well, presumably it's also significant cost savings as well. In a world of inflation in mines, 44% reduction in tailings management, and I would say just more generally, not just sovereign tailings management is often the bane of every mine manager's life.
Yeah, look, after what happened, in Brazil with a few other of the bigger miners, I think tailings management has been on the forefront of any corporate board's mind for any of the big miners. And then final question, because I feel I've grilled you enough. Trying not to. On this optimized PFS for total revenue $16.4 billion. I just want to be clear here, because that's the total revenue under the parameters that you currently have. But it's my understanding, you haven't explored the entirety of Kasiya yet, have you? There's still more to be explored. Yeah, so Kasiya's resource footprint covers about 200 square kilometers of ground. Okay. It's about 12 kilometers wide, about 29 kilometers long. But what we do know is there's some that carries on up in the north, and there's at least another 8 kilometers of ground of strike in the south as well. So yeah, this is this is a monster in every fashion. A monster in every fashion. Wonderful. That's the quote to end the interview with. Sapan, thank you very much. Yeah. Good. I think that was wonderful.
Yeah, I think
he answered some of my questions very well, and dodged the others. Yeah.
Well, that leaves us just to say, obviously, Sapan Ghai, CCO of Sovereign Metal, thanks very much for your time and appearing on the podcast.
No, it's been a pleasure, and thanks for your interest in Sovereign.
Good. Thank you, Sapan.
This podcast was brought to you by Roast PR Limited. If you would like to appear on a future episode of The Sunday Roast, please email admin@thesundayroast.net.